Now let's select the drop down. We've been looking at cycles within cycles within cycles of the accounting department. This time looking at the customer cycle, the sales cycle. We entered last time the invoice type of form, which is the accrual type of form, the sales form, which increases the accounts receivable. And that naturally leads us to the next part or the next step, which is to receive the payment from the customer. And so the way to envision this, let's look at the flow chart over here before we actually enter the payment so we get this connection correct. So if I select then our flow chart, now this is from the desktop version of the home page, but it's just for the flow of the chart. We're using QuickBooks Online. This is just to look at the flow of the process. So if we're in the customer cycle, then we're in a situation here driven by industry where we have to enter an invoice because that's the custom of the industry, like a bookkeeper or a landscaper or a law firm. When we enter the invoice, that increases the accrual account of accounts receivable so that we can then track the accounts receivable and see whether or not we have been paid or not. Next, what's going to happen is we're going to get paid. The data input form to get paid in QuickBooks is going to be the receive payment form. Now, this one gets a little bit confusing at this point because there's different ways that they could pay us. In other words, we might take the invoice, try to email them the invoice and give them some kind of link possibly to pay us automatically if they could. So we get an electronic transfer, or possibly they pay us to a PayPal account or a Stripe account or a credit card account, or maybe they send us the good old-fashioned check, or maybe they come in and give us cash. So all these different forms of payment have different implications in terms of how it's going to actually, and in the end of the cycle, end of the day, or end of the process, hit our checking account. So when we get this receive payment form, if we have a system where they're going to pay us electronically, possibly, that's going to go directly into our bank account, whether we do that using like the QuickBooks Connect deposit, in which case we might have to use QuickBooks banking system, right? And then they're going to pay us and it goes into that checking account. Then we might be able to automate the system because the invoice should match out to the payment that we're going to receive electronically. And then hopefully we can basically record this and the deposit, or record this as a deposit into our checking account. If we're using electronic transfers to our bank and we're not using like a QuickBooks bank, then again, we might have some kind of link that would help us to basically collect the payment electronically and allow them to pay it directly into our bank account, which would be great, but it might not be as automated for us to record this just from the link that we give them. And therefore, what's going to happen on the banking side of things is it's going to come through to the bank feeds if we connect the bank feeds. So the bank's going to see basically a deposit. So we have this situation of, well, it's possible when we think about the bank feeds that that deposit would match up to the invoice, and we can use that matchup to then record the receipt payment and or the deposit. So that's one way that it might work. However, you could easily be in a system where we're not using a direct deposit into our checking account, but possibly an intermediary of some sort, even if it's an electronic payment, such as a PayPal, such as a Stripe, or such as a credit card. So if we're using any of those types of payment options, we have another intermediary financial institution before it gets to our checking account. And that's going to cause us another layer of problems because that intermediary component is going to group the payments together, not one at a time, most likely, but possibly group them together. And then when they put it into our checking account, it's not going to be payment by payment. It's going to be in some kind of grouped format, which means that we need to use some kind of clearing account to deal with that intermediary component. That intermediary component also might have fees that they're going to charge us for the processing of the payments, which we also have to somehow account for. So that means when we record this receive payment, it's possible for us to put it directly into the checking account at that point in time, but oftentimes we're going to want to put it into what we call this clearing account, which might be called undeposited funds or funds to be deposited, so that we can then group it out of that clearing account and deal with any payments that need to be made when we then make the deposit, taking it out of the clearing account, putting it into the bank in the same grouping that will be on the bank statement, so that we can easily do the bank reconciliation process. So that's going to be the big key that we want to kind of keep in mind whenever we receive the payments from the customer. How are we getting the payments? What kind of intermediary kind of components are there, and how can we make the reconciliation process as easy as possible by properly grouping the payments to match what's going to come through on the bank side of things, which we will see in the bank feeds. All right, so let's take a look at this.